So welcome back, everyone. I hope you all had time to grab something to drink. If this event was being held in person in Oxford, you would have all been obliged to drink tea, of course. My name is John Velland. I'm a professor of law here in Oxford, and I'm assistant director of the Center for Business Taxation. So in the first two sessions, we heard the views of the OECD, and we heard some views from the Inclusive Framework Steering Group. Now, in this session, we're going to hear some views from the private sector and academia. And we have four distinguished speakers on this panel. So we have two speakers from business, one speaker from an advisory firm, and one speaker from academia. So I'll start by introducing the speakers briefly to you. So the first speaker is Glenn Price, who currently is the Deputy Group Tax Director at Vodafone. Now, Glenn has extensive experience in the private sector, having held different positions at Vodafone and before that at Omnicom Group and Arthur Andersen. Our second speaker is Amy Roberti, who currently is the head of US federal government relations at Procter & Gamble. Amy is also vice chair of BIAC, which is the Business and Industry Advisory Committee to the OECD. And before joining Procter & Gamble, Amy worked at the OECD, and before that, she was tax counsel and then chief of staff for Congressman John Larson, who's a member of the Ways and Means Committee. Our third speaker is Barbara Angus, who currently is Global Tax Policy Leader at EY. And as I'm sure many of you know, Barbara has held a series of very important roles in government before joining EY. So Barbara was Chief Tax Counsel for the Committee on Ways and Means of the US House of Representatives. And before that, she was International Tax Lead for the US Department of Treasury and also Business Tax Counsel for the Congressional Joint Committee on Taxation. And our final speaker is Mike Devra, who you've met earlier on. So Mike is the director of the Center for Business Taxation here at Oxford. He's also a professor of business taxation at the Business School and a professorial fellow at Oriel College. So among other things, Mike is also research director of the European Tax Policy Forum and honorary president of the International Institute for Public Finance. So as you can see, we have a very distinguished panel of speakers, and I'm sure we're going to have a really illuminating session. So the format for this session is the same as that of the previous session. So I will kick things off by asking some questions to our panelists, and then we'll move to a Q&A session. And please do type your questions in the using the Q&A function, and I will read them as we go along. And towards the end of the session, I will direct your questions to our panelists. So my first question is for you, Mike. So you have been following and contributing to the debate on international business tax reform for many years now. So my question to you is, what are your observations on how the debate has evolved, how it has unfolded, and what are your views on where we are now?
Yeah, okay, thank you. I mean, I think the debate has evolved quite a lot, and I think the excellent session that we've just had illustrated that, especially in the sense that the concerns that people had and the discussion had really seemed to have moved on from the initial BEPS process. I think some people are talking about the pillars 1 and 2 as BEPS 2.0. It seems to me that they're actually rather different. And by illustration, when we think about the 2013 to 15 BEPS process, it was about profit shifting and base erosion and anti-avoidance. And I think one of the principles there was that no or low taxation was a concern only when it was associated with practices that artificially segregated taxable income from the activities that generate it. That's a quote from one of the BEPS reports. I don't think that's what we're really seeing now. I think when we look at Pillar 2, then there's been some kind of tension between two possible aims of Pillar 2. I think one is actually profit shifting in the traditional sense, and I think that may have won out with the substantive carve-out that we now see in the latest proposal. But certainly up to quite recently, there's also been a kind of aim of trying to deal with tax competition, that is to limit tax competition between countries. I think the substantive carve-out has kind of pushed it much more in the direction of the kind of traditional profit shifting, however. Pillar 1 seems to be rather different altogether, which is to say that, we've looked at the international tax system. We think there should be, for whatever reason, more taxing rights allocated to market countries. That doesn't really seem to me to be a kind of profit shifting in the same sense that the original BEPS process was. And I think that kind of leads me to thinking about, so what is the principle? There's quite a lot of work and kind of debate really about the kind of principle that profit should be taxed in the place of value creation in the kind of BEPS process. But if we think now, where are multinationals going to be taxed if both pillars 1 and pillars 2 are accepted? That is, they're going to be taxed where they are now, which is broadly where functions activities take place. Pillar 2 says they're also going to be taxed in the residence country of the parent. Pillar 1 says they're also going to be taxed in the market country. I think it's pretty difficult to kind of discern some overarching principle of where we think we are now going to tax multinational profits rather than kind of everywhere. Perhaps that doesn't matter. Perhaps an overarching principle only kind of misleads us. I think actually a better way of thinking about that is, what are the principles of a good tax? What are the criteria for a good tax? I think we could maybe talk about these, but I should say, we have a forthcoming book next month with John and others. And we talk about distortions, which are about not distorting economic activity, it being difficult to avoid, a fair allocation both across countries and across businesses, that it can be implemented in a reasonable way, and that it could be stable in the long run. And those seem to be kind of things that we should be looking at. And if that means taxing in all those different places, well, so be it. And if it means taxing in one of them, then that would be fine as well. So I think we have moved on. I think the debate has moved on quite a lot. Let me just say something about scope, which many people have talked about, and Pascal talked about, and several members of the inclusive framework then talked about. And I guess the issue here is, BEPS Action 1 talked about digitalization of the economy. We seem to have kind of moved back and forth between thinking this should apply to the whole economy because it's all becoming digitalized, or just kind of focusing on one aspect of the digital economy, or possibly consumer-facing businesses. And I think the example which Mike Williams gave earlier is quite interesting to think about. So we have toothbrushes, or toothpaste. We can kind of tax them in the way that we've always taxed them because nothing much has changed. But automated digital services are a bit new and a bit different, and we may have to tax them in a different way. And I guess my response to thinking through that is to say, well, that's okay, but at some point we have to define what toothpaste is and what an automated digital service is. It might be kind of straightforward in that particular case, but there's going to be a huge grey area where we're not quite sure whether it should be taxed in the digital way or taxed in the traditional way. And we're going to have to introduce many different definitions in the tax system in order to kind of separate those two things out, if that's the way in which we're going. And I think we have many examples of that already in the tax system, like debt and equity, which cause horrendous problems because at some point a long time ago somebody said we should treat debt and equity differently. Anyway, I just wanted to get that point in about scope there, but I think it's very interesting how the debate has moved on. I guess my final parting shot would be, I doubt very much if we finished that evolution of debate, and I think the idea that this is the kind of the end game of the chess game, if you like, that we're about to kind of reach a stable solution seems to me probably to be quite a long way off yet.
Okay, so can I pick up from one comment which Mike made? So Mike is basically saying, I think, that there's a big difference between BEPS and what we have before us now, because BEPS more or less narrowed some loopholes, tried to close some loopholes, whilst what we have before us is trying to undertake some more fundamental structural change. So maybe I can ask all three of you, so Amy, Barbara, and Glenn. So do you agree that what we're trying to undertake here is fundamental structural change? And secondly, if that is the case, do you think the business community has bought into the case for making this type of change? So maybe Amy can go ahead, then Barbara and Glenn.
Okay, I'll try trying not to completely dodge your question, but I guess I come at this from a more practical approach, which is that I don't think fundamental change is necessarily possible. and certainly not in this context and in this atmosphere. I think COVID makes it even more difficult, as one of the panelists said on the last panel, but maybe it makes it more important, but certainly makes it more difficult. That said, I think that business fully recognizes the need for change, and in fact, most of us want change. And I would argue that the business community has helped keep this project going, because many of us see on the ground in audits or in disputes that that there's a need for some shift here, and we want to help get there in a way that's constructive and that gives us some certainty. But I just don't see that in this atmosphere we're going to get to fundamental change, and maybe that's the wrong goal right now. The past panel, the last panel, you could see there are still differences. It's not just business that doesn't agree. There are still differences in governments and how they approach this and what they think the answer should be. One thing that I think could help with the business community, and we've argued for this, is, as Michael, you and John have written extensively about a destination based tax. I think for some governments and for some business, it's sort of a bridge too far. So is there a way in this project to limit this somehow that would give people more comfort or more of an understanding of what we're talking about here? And maybe that's this idea of an A+B cap, some kind of limit. Maybe it's based on system profits, but just a way to say, look, this is where we're going. We're going here, but we're not going all the way over there. And I think that could help reframe the conversation in some ways, and help us have a more constructive one. The other thing I would just point out in terms of business accepting where we are and accepting the premise, I think for consumer facing business like mine, and everyone keeps talking about toothpaste and toothbrushes, which we make Crest and Oral-B. I think I'd rather go back to Mike's example from the last time we were in Oxford about milk. And he said, look, the milkman used to put it on your doorstep, then you had to go to the store and get it, and then you could order it online, but it's still just milk. And so the way I look at it, you might buy the milk because we advertise the milk to you, and maybe that's digital. But if you don't like the milk, if we don't innovate so the milk lasts longer on your shelf or has more vitamins in it, then you're not going to buy it again. And so, so really, I think it goes back to what's different here. And for consumer facing, I wouldn't make the argument that we shouldn't be in scope, or that, but I think it's more that you have to take into account that there are different degrees here, and potentially take that into account in Amount A. So it's a long way of dodging your question, John, but I think the answer is that fundamental change probably isn't what we're talking about here, isn't achievable.
Okay, I'll give Mike the opportunity to plug the book again in a few minutes, but Barbara, maybe you can address that.
Thank you. It's a pleasure to be here. I think Mike made a very good point at the opening, that referring to this project as BEPS 2.0 is a bit of a misnomer, because it really is a very different project than the first BEPS project. It aspires to make fundamental changes to core building blocks of the international tax system, and I share Amy's question about whether that's achievable now at this time. But the objectives are so different than the objectives of the first BEPS project. I also think referring to it as addressing the tax challenges of the digitalization of the economy is also a misnomer, because it goes beyond digital, potentially in Pillar 1, depending on how scope ends up being defined. And certainly in Pillar 2, that doesn't seem to have anything particular to do with digitalization. And so I think it's important to be upfront that this is a fundamental rethink of longstanding principles on Pillar 1. The nexus rules, the permanent establishment concept, and the arm's length principle are not being abandoned, but something is being developed to supplement those rules. in some ways that might be even more complicated than abandoning those principles, which I'm not advocating that they should be abandoned. But if you're supplementing them, then you need to make those connection points. Something that Richard Collier used to talk about a lot, the hardware or plumbing to connect the new rules to the old rules is so important. On pillar 2, that focusing on there being a tax rate that simply is too low without regard to whether there are any harmful practices associated with it is somewhere that the OECD has not ventured before, and really is very different. And on the question about whether the business community is accepting of that the case has been made for these changes, I guess I would say the business community is very engaged on this project. The pages and pages of comments, the participation in conferences like this, the participation in the OECD's consultations, make that clear. They recognize that there are really core aspects of the tax system at stake here, and that they need to be engaged because these potential changes go really to fundamental business models, and so without that engagement, you could have a sort of separation from the real world. But I think that as the details get fleshed out and the blueprints flesh out a lot more details, it really is important to step back and look at how the proposals are evolving and try to connect them back to the fundamental principles. I think one of the delegate from India in the last panel made a good point about this being a time, this consultation period, and kind of quiet time in the negotiations is a good time to step back. And I think one of the things that all of the participants in the project should do is to step back and see where it is that the blueprints have gotten and how that connects to the original objectives, and does it really connect, or does there need to be an adjustment? Because I think having underlying principles in a project where you're never going to be able to answer every question is essential.
Okay, so if I pick up on the business community point, and really think through conversations that I've been hearing, I think whether business has accepted the case really depends on pillar 1 and pillar 2, and I think you have to look at them separately and then combined, noting that they likely will be a package. I think if we look at pillar 1, I think many businesses accept that digitalization has brought a fundamental commercial change, and hence it is appropriate to fundamentally change aspects of the international tax architecture. So I think when we look at new Nexus rules, I have many multinationals who completely accept that some new Nexus rules are appropriate, and there's a sensible way forward there. I think when you look at other aspects of pillar 1, I think many consumer-facing businesses really feel challenged by this. I think many feel that the Pillar 1 proposals are disproportionate to the challenges that consumer-facing businesses may or may not create. And I think the inclusion of consumer-facing businesses feels much more about politics rather than policy. But that said, I do think there are grounds of Pillar 1 which do make sense. I think when we look at pillar 2, I think that starts getting much more complex. I think many multinationals do accept that the CFC side of pillar 2 is understandable. But then I think as you go beyond the CFC rules and the CFC aspects of pillar 2, when you work through the complexity there, the potential double tax relief and the problems that could ensue, then I think many businesses are struggling to see how, when you look at both pillar 1 and pillar 2 as a package, that it starts to get easy to say, starts to get complicated, and I think multinationals are talking about the counterfactual and saying, well, what is this? If the counterfactual, which I'm sure we'll get onto later, but if it is just digital taxes, then perhaps we don't really agree with where pillar 1 and pillar 2 are heading.
Okay, Mike, did you want to come back on any of that, or okay? Okay, so let me just pick up from when one of the points which Glenn made, which is some of the issues or the challenges which these two proposals bring to businesses. Now, I'm sure you could speak of a whole range of challenges, but could I ask you, maybe again now starting with Glenn, then Amy and Barbara, to pick out one or two key challenges which you think these proposals bring to business, and perhaps whether you see any way of overcoming those challenges?
Sure. So it's interesting that Mike just talked about the principles of taxation, because I look at the key issues that I've listed here: tax certainty, complexity, administrability, and double taxation. They would be on the list of any set of tax principles, and certainly the Ottawa tax principles. If I just reflect on the last point of double taxation, I think that there's many aspects of where we're heading which are of particular concern. If I look at Pillar 1, withholding taxes deducted at source, I feel need much further consideration. And I've worked through various scenarios, and you start to go through the maths on some of this, and it is quickly getting to the stage where you can't really understand the broader rationale of this. So if I think about a situation where a market jurisdiction is levying, say, a 10% withholding tax on some fairly anodyne services, maybe technical service fees charged out at cost plus, as you start to work through the maths of Pillar 1, and you've got a withholding tax on gross revenue taxes in a market, I struggle to see the rational way that any market jurisdiction could be allocated more amount a tax when they're already, levying a large amount of withholding taxes in the country. And I think as we work through, double tax being one of the key issues, and then we start to consider how we as multinationals best address them, I think we also need to take a pause. We also need to reflect. I think more multinationals need to run the maths and look through all the complexities that the proposals are actually creating. And I think we need to work with the OECD, and we need to work through the governments and the tax authorities of the countries in which we operate. And we need to share with them all the different situations where double tax will arise, and then work through all the situations where double tax relief wouldn't actually, be guaranteed at the moment. John, you're a professor of law. I'm sure you'd be stunned if you look through some of the wording which says that, countries could consider double taxation relief. It would be preferable, and there's a lot of potential double taxation, and there's a lot of opportunity for that double tax not to be relieved. And I think that is one of the key challenges that we face, and multinationals have to work with the OECD and governments to ensure that can be eradicated.
I couldn't agree more with Glenn. I think that's a very good point, and a very broad point that is throughout the report, and that I think we all need to address. I would give maybe 2 or 3 specific examples where I see both political challenges, but also sort of economic challenges and things that sort of challenge the principles of behind all of this. And I guess the first one I would point out is segmentation, so regional segmentation. I think it's very hard to imagine that politically it would be feasible for a domestic business, if the IP is in the US, if things are sourced there, managed there, that we would allocate those profits away from the US somehow. So I think that, and it's not just a US issue, it's any really big market with multinationals, I think would face that same challenge politically and also economically. And so at a time when governments need revenues more than ever, this is all very politically charged. In the US, we have a new president, it looks like, President-elect Biden, who sort of ran on Make It in America, a focus on manufacturing and reshoring. that that somehow this would be politically feasible in the US, I think is hard to swallow. And so I think it seems like the OECD and countries are open to ways to solve this issue or minimize the impact. And I think regional segmentation could be one way to manage that. I think the other one is certainty, and we will forever be advocates for let's keep going on amount B. If you think about tax certainty in this context, we've solved for, if you create a new taxing right in amount A and then create a process that I think is very well intentioned and could be quite good around amount A. But that's not really adding additional tax certainty. It's sort of solving for this additional uncertainty that you've brought to the table. But amount B it's 65% of MAP cases are around distributors. And so if you could solve for amount B, I just think this is a huge opportunity. We also heard on the last panel discussions about simplification. I think this is where huge simplifications could come in amount B. And this is where it's good for business, it's good for governments. And so we feel strongly that that should be a part of this. And then finally, I think maybe we can go back to scope, but I agree with Pascal that this is the biggest issue politically. I think that it would go a long way if you solved it. And I think it seems to me that this ADS, CFB, way of going at this is not acceptable. It doesn't matter if it's acceptable to us. It doesn't sound like it's acceptable to governments. And so I think we have to get creative and think of a different way to approach it. And it's a tough issue, but until we can find a solution to this, I think it makes it very difficult to move forward.
Well, I mean, I'm going to continue the theme of double or multiple tax and the need to avoid that as being a key issue for business. And I think from a double tax perspective, there's both there are issues in both Pillar 1 and Pillar 2, and there are substantive issues and also kind of process issues that both need to be addressed to ensure that double tax is not a result, or is the potential for it is minimized. In terms of Pillar 1 and the substantive rules, I think that the innovation in the blueprint of the distribution and marketing safe harbor is an important development. But the fact that it's a safe harbor, and I mean, it recognizes that there's a connection between what your transfer pricing allocates to a market and amount A that doesn't exist in amount A. In other words, amount A as it's structured would allocate to a market without regard to how much profit is already in that market. And the safe harbor addresses that in a situation where you allocate, where what you already allocate exceeds the safe harbor, but the same issue arises if you're below the safe harbor. And so finding a way to make a better connection between how much gets allocated under amount A based on how much you already allocate seems important. Otherwise, I think you create an incentive to find a way to change the transfer pricing so that you're not allocating as much because you don't get any credit for it under amount A. I think another issue, and it touches on something that Amy talked about, is the issue of who is the jurisdiction that the profit is coming from. And what countries does that jurisdiction allocate to? Right now, you've got sort of look first to the markets that entity has a connection to, but then you look to the whole world and do something that one of my colleagues refers to as spreading the peanut butter around the world, and that I think that's a difficult point. And maybe regional segmentation is a way to solve for that, so that you're only allocating between countries that have a connection with respect to that amount of profit. Another issue is the elimination of double tax rules While I appreciate the deference to countries' domestic rules on double tax relief, this amount A seems like a different animal. And it seems to me that the only way to be clear that you are eliminating double tax is to have full 100% exemption, whether the country is a 95% exemption country or whether it's a foreign tax credit country. The limitations that are provided under the foreign tax credit rules, the restriction that's provided when you have less than 100% exemption seems inappropriate here when you're taking global profits and reallocating it to a particular jurisdiction. I think you need 100% exemption as the mechanism to eliminate double tax. You also need the dispute resolution mechanisms to ensure that once you get past the technical rules, that they're being applied consistently and implemented consistently, and you really need dispute prevention. In the case of Pillar 2, I think there also are double tax issues, and two that I would point to that seem like they need further consideration is the limitation, is all of the carryover rules that apply in calculating the effective tax rate under Pillar 2. They really are too limited. Having any kind of time limit on a carry forward means that there will be double tax. Not having a carry back means that when you take into account the time value of money, you don't have real elimination of double tax. And without some kind of mechanism that deals with trapped amounts, you can end up with absolute double taxation if you've got an entity that was subject to a minimum tax and has no way of recovering it through the carryover. And so I guess I would continue to encourage the inclusive framework to think about deferred tax accounting as perhaps a solution. If that's not a direction, it seems like the carryover rules need to have a lot more flexibility built into them. And I continue to struggle. Well, I appreciate the attractiveness of the subject to tax rule and the ability to apply a gross basis withholding tax. I continue to struggle with how you can connect a gross basis withholding tax as a mechanism for achieving what is a minimum tax that's based on a net income tax level. That's a really blunt instrument, and one that has not been something that the OECD has advanced in the past. The OECD has been a champion for reducing gross basis taxes wherever possible. And so I think that's an important area that needs further work.
Sorry, okay, Mike?
Well, briefly, I think this is a question for business. I wouldn't want to presume to speak for business at all, but I could just pick up two of the points that have been made, which I do seem to be very important. One that Glenn mentioned about certainty and complexity. Now I have recently done a survey of businesses about tax uncertainty, which demonstrates that tax uncertainty is very important for the way that businesses behave and where they locate and how much they invest. So I think there are real fundamental economic issues here related to those kinds of issues. So I would certainly support that. And I think that the double tax point on Pillar 1 in particular, is we're kind of inventing a new level of tax, and clearly, the intention is not to have a new level of tax which is additional on everything else. So the way that we give double tax relief there is clearly very important as well.
So could I come back to the question of complexity again, because this is something, as a pure academic, I find it really hard to get a handle on, right? So when I see these proposals, they look incredibly complex to me, but then I think, okay, maybe this is just me being an academic. If I was a practitioner steeped in all this detail, I'd be used to this, and it seems like a bit more work, but maybe not that much. So my question, and I'm very conscious of the fact that both Glenn and Amy, work in huge multinationals, so you should have great resources, etc., to deal with tax issues, right? So, but is the question of complexity something that even a multinational of the size of the one you work for, is it something you are actually really concerned about? Sorry, Amy?
Complexity multinationals can handle it. You have to spend a lot of money dealing with it, but I think complexity breeds uncertainty. And so if rules are very complex, then it's easier to get them wrong or fear that you get them wrong, and you might change your behavior accordingly. For me, complexity, the bigger issue with complexity is that it also breeds distrust. And so if there are countries that can't apply the rules, then that relationship between business and government is hurt by that. And so if the rules seem like they're stacked in our favor because we understand how to apply it, we can put the resources toward it, then it causes a difficult relationship with the government, but it also breeds distrust in the public. And so I think that that's something that we should all, it should be a goal for all of us in this, that if we can, the tax system will never be simple, but we have to be able to keep in mind that the vast majority of governments right now can't apply the transfer pricing rules or don't have the resources to do so. And so how do we find ways to simplify? And again, I keep going back to Amount B. I think that's would be one step forward here. I'm sure there are others, but I think that's the bigger issue with complexity.
Sorry, Glenn, did you?
I agree with a lot of what Amy has said there. I think you know, the more complex, the more open something is to interpretation. We're going to be dealing with these rules across 140 countries. We're going to get different tax inspectors, which will take different approaches to the same set of facts. That's going to, you know, it's going to take up a lot of time. Perhaps, you know, multinationals are better equipped to be able to deal with that. But it does completely erode trust. It starts to damage the relationship. You're going to have issues which are going back 5 or 6 years, or possibly more, because the issue is so uncertain. And that is, you know, that then creates, you know, more uncertainty. You then have to start providing and, you know, putting provisions up for some of these items, and it shouldn't have to be like that. It should be possible to come up with a simple solution. You know, Amy's example of Amount B is an excellent one. That's an area which is crying out for simplicity, and I think more resource has to be put on those items now to say let's get the right solution. Let's not just rush to a quick solution because governments are pushing for this.
Yeah, so this leads me to a point which Glenn already alluded to, which is the counterfactual, right? And we've heard discussion of it in previous sessions. So if we're faced with the choice doesn't seem to be between the status quo and the blueprints, but it seems to be, the choice seems to be between the blueprints and something else, perhaps a series of DSTs across the globe, maybe something even broader. So, I mean, is it right to think that this is the option, the choice before us? And how would you reflect on that choice from a business perspective? Perhaps Barbara can go first now.
Sure, and I think the counterfactual is, I think to be fair, you really have to think about it not just as DSTs, but as unilateral measures with respect to Pillar 1 as well. And there have been some. I mean, they're certainly in the eye of the beholder, but some have looked at some mechanisms that have been put in place in the last few years in countries as being a start toward a unilateral measure that's not limited to digital, but that relates to concepts in Pillar 1. And I think that the idea, while there's a lot of complexity and probably too much complexity in what is being considered under Pillar 1, there's a different kind of really troubling complexity of a whole series of unilateral and uncoordinated measures. And I think that's a real risk for the business community. My hope is that the countries stay at the table and continue the discussion. I think the longer that they're at the table and having a discussion, the better. I agree with some of the skepticism on the prior panel as to whether mid-2021 is possible. But if progress continues to be made, I hope the deadline continues to be extended, because a world in which some countries do digital services taxes, others create some kind of digital PE, others just unilaterally deviate from the PE concept beyond digital. And then all of that is just dealing with Nexus. You've also got to pick up what are the profits that they go after, and those are a whole variety of deviations from the arm's length principle. That really would be chaos and would be very hard to recover from, and would be a real barrier to cross-border trade and investment.
I forget who was next.
John, you're on mute. Amy?
Go ahead, Amy.
Go ahead. Well, when you asked this, I was thinking 2020 has just been a terrible year for a lot of reasons. But one that I can think of is just we've introduced this concept of trade remedies into tax, which has sort of always been there, but we've seen these with the US Section 301 investigations on DSTs. And you start to think, how much worse could this get? And I think the answer is it could get very dark. So I think now that you've sort of let that out of the bag, anyone could take these trade-based approaches to a tax case. And I also think that the worst case scenario on Pillar 2 would be if it doesn't work at the OECD, and if the European Union, for example, takes up their own sort of minimum tax, because the only place that anyone is talking about the implications of GILTI is at the OECD. And so for US companies, GILTI is extremely onerous. Almost every company pays it, just no matter what your effective tax rate is. And so I think a world where there are two separate systems that US multinationals would have to comply with is a very tough thing to think about. So I think that this has to work. We're all here because we believe that this OECD process needs to work. We need to get some kind of agreement, because the counterfactual, as I said, is pretty dark.
So on the counterfactual, I absolutely see many more unilateral taxes, and I think perhaps Vodafone has a unique place in the conversation here, because the telecoms industry has been suffering high unilateral sector-specific revenue-based taxes for some time now. We actually call them TSTs, so telco service taxes. Just like the proposed DSTs, they are designed to fall outside double tax treaties, and they are designed to fall outside VAT or GST regimes. As yet, no multilateral body has addressed those, but they are very real. They're not just proposed. If I look at the counterfactual potentially extending to even more unilateral taxes than we currently suffer, then it concerns me, because from our position, I can say, yes, those unilateral taxes do cause double taxation. That's their design. They do have administration costs quite extensively, and they do harm growth and investment. And businesses do have to consider passing such costs on to the consumers or the customers. So I think there's a very real danger that if the multilateral solution fails, that perhaps because the US has already opened up the debate to include consumer-facing businesses, we might see other countries starting to apply unilateral sector-specific revenue-based taxes to CFBs. That's the way to counter the US not coming to an agreement. And yeah, Amy, I would completely agree that is a very dark situation, but I think it's a very possible one.
Mike, would you like to add something?
Yeah, thanks. I mean, I agree with the others about, the likelihood of getting more unilateral taxes. I think I think there's some difficulties in thinking that through. And the DSTs, the taxes that Glenn was talking about, they're based on revenues. We could think, in some sense, we could think of them being sales taxes. And typically when we think of sales taxes, we change our mindset. We don't start talking about double taxation. We worry about consumers. We think about them in a completely different way. And actually, think we shouldn't think about them in a completely different way, because the only difference is whether we get relief for costs or not. So I'm certainly not advocating sales-based taxes or DSTs, because actually from an economic perspective, I think it's much better to tax profit than it is to tax sales generally. However, it's quite interesting that the place in which these taxes tend to be levied are the market countries, and I take it that's because governments can do that. That's a place where you can actually at least collect some tax. It's much more difficult to collect it elsewhere, as the entire problems of the international tax system and BEPS, as we've seen over many years, makes that more difficult. So I think in principle, taxing on a destination basis, I think there are good economic reasons why that would be a good idea, and some people have alluded to that. I think taxing gross revenue is not a good idea generally, and I think it is true that the kind of unilateral taxes that we are likely to see are more likely to go to gross revenue, because that's much easier to tax than it is to try and figure out what the underlying profit that you've made on this sale is. So I think there are dangers there, but I think we also need to kind of think through a bit more carefully the relationship between taxes on sales and taxes on profit.
Okay, so Glenn, did you want to come back to on that point? I saw you unmuted yourself for a minute there.
I did. So I was going to comment that these are not sales taxes. I can understand the similarity being made, but some of them are introduced with very clear rules that you cannot pass them onto consumers, and that leaves any company bearing those taxes in a very difficult situation as to what to do there. It ultimately causes profitability issues, but it can lead to that profitability being wiped out, and there's some very negative effects of suggesting that multinationals shouldn't be profitable in a certain country.
So I must say, from an academic perspective, I'm really interested in these TSTs. I hadn't come across them, but I won't sidetrack us just because I'm particularly interested in that. But so now I thought one thing we should address is something which kept coming up in the first session and the second session. And I'm afraid I'm going to turn to you, Barbara, to see if you can enlighten us on what the US's position is likely to be, or even the general approach is likely to be, if, as expected, we should have a new administration in the coming months.
Well, and I guess I'll start by saying this is speculation. The new administration is working through the transition phase, and the a position on the OECD BEPS 2.0 project was not part of any of the campaign messaging. We didn't hear about it in any of the debates, but I think there are some significant signals, and maybe I would just start from history. The U.S. has a long history of being very engaged on all OECD tax matters, and having the position, while the tone and specifics may change, but having the position continue from administration to administration. So the concept of not ring fencing digital is something that began in the Obama administration. And continued into the Trump administration, and so I think we could expect to see some continuation. So focusing first on Pillar 1, the U.S. has, on a bipartisan basis, expressed their opposition to digital services taxes. We have, and it may be one of relatively few wholly bipartisan issues in tax in the past couple of years, but both the chairman and ranking members of the tax rating committees have communicated collectively and repeatedly about their opposition to digital services taxes targeting the U.S. tech industry, and in those communications have expressed a preference for a cooperative multilateral solution developed through the OECD process. Now, I wouldn't interpret those letters as being an endorsement of exactly what the OECD is developing, because it's still being developed. and Congress will focus on that when there is something more specific to focus on. But given the bipartisanship on that, I would expect there to continue to be a concern in a Biden administration about digital services taxes, and a preference for something that is more coordinated and multilateral. I would expect there to continue to be concern about singling out digital for special and specific tax rules, and so that will lead to the question of scope. And I would expect, just as this administration has, Vice President Biden, President-elect Biden's administration to struggle with the question of scope. I thought the prior panel really described that very well. That if you broaden the scope, the U.S. Has to deal with the fact that simply brings in more U.S. companies. Even things like having a revenue threshold, the country by country reporting threshold, which I think is a very good practical solution to ensure that the complexity of these rules apply only to the largest businesses, also increases the proportion of U.S. businesses that fall within this. And those are all challenges that will have to be dealt with. I think the perspective of the U.S. business community will be really important, both to Congress and to the new administration, as it has been, and that dialogue will need to continue. On Pillar 2, the current administration has been very supportive of Pillar 2, and I would expect President-elect Biden's administration also to be supportive of Pillar 2. We have seen that in the campaign tax plan, they've included some proposals for changes to the U.S. GILTI regime that would have the effect of bringing the GILTI regime more in alignment with the design that the OECD is choosing. I think that's more coincidental than borrowing from the OECD, but it would mean that a Biden administration might be able to be more focused on the fundamentals of Pillar 2, with less need to focus on this very important question of GILTI grandfathering. But that all is dependent on whether that there is an ability to move some of those changes, the move away from a blending approach, for example. Is there really an ability to move changes like that through the Congress, with a very divided Congress, very close margins, and a margin that we don't know yet in the Senate? But so I would expect that the President-elect Biden's administration to be very focused on Pillar 2, with similar objectives as the current administration. So while this was is an election that will lead to very significant policy changes in many areas, I don't really see significant policy changes in this particular project.
That's fantastic. Thank you very much. I mean, Amy, would you like to add anything to that, or any particular insights?
No, I think Barbara covered the complexity of this pretty well. I think that there likely will be a divided Congress, which would make anything that requires legislation or a treaty ratification more difficult. But when I look at this project, I think that I don't think we're talking about implementation in the short term. It's in the longer term, and so maybe that's okay. So I think we all look forward to this sort of reset to see where the Biden administration will go. But I agree with Barbara that the U.S. has had this longstanding position, and I think it's hard to imagine that, given our economic challenges that we're facing, and given the influence of US business because of jobs and their impact on the economy, it would be hard to see the US taking a much different position on some of these fundamental issues. But we do expect that this administration will work in a bipartisan or a multilateral way, and that it sounds like the other countries are welcome that. So I think it's very positive.
Great. So, I mean, we have about 12 minutes left, and I'd like to end by asking you, what you'd consider to be a good outcome by mid-2021. But we have some more time, I think, to fit in a couple of questions before that. So I'll take a question which has been put on the Q&A, but I'll simplify it a bit. I mean, is it naive to think that, if agreement is reached on Pillar 1 and Pillar 2, that unilateral measures will just, disappear? I mean, I know it's, asking you to speculate about something which might or might not happen, but, should we be concerned that actually, even if, okay, it's more likely that unilateral measures won't proliferate if there's agreement, but is it naive just to think that, okay, if we have agreement, then everything else will fall into place and unilateral measures will be withdrawn? I'm glad to see that Glenn is taking this up.
I've gone off the mic to address that. I think it's completely naive. I think there is a commitment to address the digital unilateral taxes. I haven't seen any clarity on a commitment to address all unilateral taxes.
Barbara?
A very, very, very good point. That there's reference to digital services taxes. There's a general reference to unilateral measures, but no definition of what constitutes an existing unilateral measure. I think it's important that that's spelled out, and recognizing that what is in the agreement, it is essential that the agreement include an agreement to withdraw whatever is a unilateral measure. And an aspirational agreement to forbear from putting unilateral measures in place, recognizing that circumstances will change and it will always be a risk that there will be unilateral measures. It is really important that as to the existing measures, there is solid agreement on that as part of any agreement on Pillar 1 and Pillar 2.
Amy?
I completely agree. And I think that I completely agree with what Barbara just said. And I think that even companies that aren't impacted by the DST should care about an agreement around unilateral measures and those being withdrawn, because as Glenn demonstrated, it can spread. And so maybe now it's platforms and in the future it's something else. And if we think that unilateral measures are wrong, it shouldn't necessarily matter who they're levied against, but it's not good policy and it's not the right solution. So I think that should be an important part of any solution.
Mike?
I mean, I agree with everybody else in the sense that there's still an incentive for countries to raise taxes in ways which they think are going to be useful without doing too much damage. I think it's quite interesting to think about these as kind of unilateral measures where most of the other panels and indeed this panel have been talking about multilateral measures and how we need widespread agreement and we need the US to agree before we can actually do anything. Here we're worrying about countries going off and doing their own thing. I think it'd be extremely difficult to write down in an agreement saying, okay, this country is not allowed to have this kind of tax, because it'd be very difficult to, I think as Barbara's mentioned, to say, okay, well, what's acceptable and what's not acceptable. And can we take a DST and rename it or turn it into a sales tax or indeed a tariff, which it effectively is, or call it something else? And so I think the interesting thing is again, it comes back to kind of what kind of tax. Some taxes would be harmful to governments to introduce. Other taxes would be much less harmful in terms of the kind of international effects and the impact it would have on multinational companies. And I think there's actually this divide between Pillar 1 and Pillar 2, actually, if I can kind of digress slightly. Pillar 1 is a tax, where the market is, and this is, the DSTs that we see are based around that. Countries can do those kind of taxes, and they don't seem to care that much about double taxation beyond that. Pillar 2 is much more difficult, I think. Should the UK introduce Pillar 2 if other countries do it? Well, perhaps not. It depends on whether we can attract the headquarters of other multinational companies into the UK, if France and Germany do it. And so I think there's a much more of a tension there, which is to say it's probably, doing Pillar 2 is something that's an individual country is quite unlikely to do on its own, or that kind of tax. I think the US is an exception here with GILTI, but the US is a very different country than most of the ones we're thinking about. Whereas a tax, a tax on sales or in a destination country is much more likely to be seen, I think. And agreement on pillars 1 and pillars 2, I don't think will take that incentive away.
Okay, I was actually going to ask, given how complex everything is and given some of the elements introduced in Pillar 1, I was going to ask, is there a point where the business community might actually say, you know what, let's take why don't we try and agree on a simple 3-factor formula apportionment system? It has issues of its own, we know, but if the options are the existing system plus Pillar 1, Pillar 2, and maybe some unilateral measures, why not something like unitary taxation formula apportionment, which I never advocated, but clearly has some strengths, and maybe it's easier for the public to understand as well. Because one thing I keep thinking about in all of this is if Pillar 1 and 2 were agreed on, do we think the political and public interest and dissatisfaction with the way companies are taxed will actually go away? I'm not sure it will. So I don't know, Glenn and Barbara seem like they might be interested in answering that question, which is good. Glenn, perhaps I saw you do it first.
Sure. I think multinationals, given what we're facing now with Pillar 1 and Pillar 2, they would be far more open to it. Multinationals want simplicity, and if we can find a simpler way of doing that, then perhaps it would be a better alternative.
Barbara?
And I wanted to pick up on your point about whether you satisfy the public interest, the sort of what has been over the years some public outcry about companies not paying their fair share in the country where the market is located. I think that's a real concern, and in some ways the First Steps project was a response to that, but it didn't really address what was the underlying concern of the public. It seemed to be this idea that this foreign company is selling something to me, and that's when it makes money, when I pay for the thing that I buy, and therefore my country should get to tax it, and which really is talking about a consumption tax. And I am concerned that with all of the complexity and all the things that the government policymakers are trying to achieve with Pillar 1 and Pillar 2, it isn't achieving that the thing that the public has had an outcry about. And this time I feel like if there is an agreement on Pillar 1 and Pillar 2, it is really important that it be accompanied with an education effort about why 100% of the profit is not being allocated to the market country, because that isn't how income taxes work. That if we don't deal with that in some way, the public won't be satisfied. They're not thinking that some additional incremental part of the profit should be in the country. The view seems to be all of it should be in the country, which isn't the right answer. But we need to take that head on, and I think that's a shared responsibility of government policymakers and the business community to try to communicate about that, or there will continue to be public outcry, which will be aimed both at the business community and frankly at the governments for having failed to get as much of the profit as they should have gotten.
Right. So let me just ask you the final question, which I had on my list, which is, given where we are now, what would you consider to be a good outcome by mid-2021? I noted in the previous panel there seemed to be some disagreement about timelines, but so given that the official goal is to get agreement by mid-2021, what would you think is a would be a good successful outcome by mid 2021. So let's keep it a bit brief because I know Pascal and Mike are waiting for the next session. So perhaps Amy, could you go first?
So I understand the need to drive this forward, but I do think that the US just had a big election and that should be a reset somehow, that and that we should have a little bit of time to engage and try to find constructive solutions. And I think mid 2021 is pretty quick. What I hope happens between now and then is that you get firm commitment from the US, both the Congress and a new administration, to engage. And maybe this might be a little bit wishful thinking, but some parameters like a cap or some things that help focus the conversation. Maybe it's some more agreement around scope, but just some things that can help focus the conversation and then enable us to get it to an outcome in the future.
Glenn?
So very similar answer. I think, you know, the successful outcome would really be agreement with the US on scope. That's the elephant, which really needs to be addressed. I think going beyond that is possibly asking for quite a lot, because that's where the focus has to be. But if we were to go beyond that, I would want to see a commitment to address all current and future unilateral taxes. I'd want a guarantee on double taxation relief, which uses clear legal wording, not could or preferable. And then I would like to see a focus on simplicity, dispute prevention, and dispute resolution as well. But that's probably a bit of a hopeful Christmas list.
Barbara, can I ask?
Very, very similar answer, I guess. But in 2021, I'd like to see all of the countries still at the table having discussions. Obviously, there's a big focus on the US position, and I think there'll be more clarity around that as the new administration gets in place and focuses on this, but that will take some time because it will require that the right people be in place at Treasury. I also think that the prior panel made clear that there are other political issues that need to be resolved. And there certainly are technical issues that need to be dealt with. And I don't think you can completely separate the political and the technical. I think that the tremendous work that was done on the blueprint and filling out an awful lot of technical detail has raised more questions because there are specifics to look at. And I think that's an important part of the process. Better that the business community and the governments are looking at those technical details now and resolving questions about them than that happen in the implementation phase. So I think there's plenty of work left to be done, both political and technical, and it goes hand in hand. And I think that the countries ought to stay at the table.
Thank you very much. Mike, I'm about to hand over to you for the next session, but why don't you,
Okay, give me 30 seconds on this one, since everybody else had to go. I mean, I agree with everybody else, really, in the sense that, I mean, I think the inclusive framework and the steering group was doing a great job, and I think we've had some very thoughtful contributions from members of the steering group already. It seems to me, that it's extremely unlikely that we're gonna have the basis of a stable tax system going forward for decades, in the next 6 months. So I guess a successful outcome from my perspective would be some kind of staging post that, we can get to somewhere where we agree that, some kind of direction, or at least some kind of recognition of what has to follow. So I think we're in a process, and I think it's, that process is very unlikely to be done within 6 months, so that we can all kind of stop thinking about all these things and just pay our taxes and get on with our business.
Thanks, Mike. So you set yourself up for a tough final session with Pascal, I see.
Pascal this now.
But allow me to just close this session by thanking Glenn, Amy, and Barbara. I genuinely enjoyed this session, and I hope our audience enjoyed it too. But I'll pass on now to Mike and Pascal for the final session. So thank you, Amy, Glenn, and Barbara.